The central bank's battle to tame inflation has been likened to a marathon, with the last stretch being the toughest. Governor Tiff Macklem's message: cuts are on the way, but for now, it's wait and see.
We don't want to keep monetary policy this restrictive for longer than we have to, but nor do we want to jeopardize the progress we made in bringing inflation down.
That progress, the result of 10 interest rate hikes in the past 2 years. They've helped tame economic growth. Canada narrowly avoided slipping into a recession at the end of last year. The steam has come out of the labor market and inflation has cooled below 3%. But the central bank and economic observers are concerned about external risks that can drive up transportation costs. Conflicts abroad, attacks in the Red Sea, traffic slowing through the Panama Canal.
Things are unpredictable. A lot of our inflation isn't Canadian generated. If there's a war, if there's a pandemic, if there's a supply chain issue, all those increase costs. We don't control the price of oil.
Domestic risk factors include persistently high shelter costs, rent and mortgages. And even though it's a hold on interest rates from the Bank of Canada this time around, we have an inkling of what's around the corner when and if cuts are announced. A recent survey shows more than half of people across Canada who've put their home buying plans on hold in the last 2 years say they'll return to the market when the central bank reduces the key lending rate. 10% say even the smallest of rate cuts, 0.25%, will be enough to prompt them to jump back in. Most economists expect the first interest rate cut to come in June or July. Gaviola, Global News, Toronto.